Good morning, everyone. I'm Leandra Lederman, the William W. Oliver Professor of Tax Law at Indiana University Maurer School of Law in Bloomington, Indiana. And I'm very pleased to host Stephanie Hoffer, who's with the Indiana University McKinney School of Law up the road in Indianapolis. So if you're not familiar with Indiana University, you might be a little confused about why we have two law schools and they're similarly named, but they are in fact quite separate and located in different places. It's terrific, though, to be able to have tax colleagues who are just up the road about an hour. So Stephanie Hoffer is the Lawrence A. Jagan III Chair in Tax Law at the Indiana University McKinney School of Law. Her scholarship focuses on U.S. federal income taxation, tax administrative procedure, and opportunities for financial wellness at the intersection of tax and disability law, work for which she received a Fulbright Award. She's presented her work both at home and abroad and has testified before the U.S. Treasury, the IRS, and various legislative committees. Her research on tax collection due process won the John Minor Wisdom Award for Best Lead Article in the Tulane Law Review, and her work on tax administrative procedure has been cited by federal courts. She serves periodically as a visiting lecturer for the Vienna University of Economics and Business. She was a professor at the Ohio State University Moritz College of Law for quite a while, as well as a visiting assistant professor at the Northwestern University Pritzker School of Law. She teaches federal income taxation of individuals and businesses, tax policy, international tax, and contract law. And today she's going to be presenting her very interesting work in progress titled Tax Legislation in Crises. With that, Stephanie, welcome to Bloomington, and the floor is yours.
Thank you so much, Leandra. I really appreciate it. I am so excited to be with you guys this morning and to get some feedback on this draft. So let me start by saying I began this project in response to an invitation from some former students at OSU to write something about congressional tax responses to crises. And even though this is a little bit outside of my normal wheelhouse, I agreed, and in part because for over a decade, Congress's repeated use of expensing and depreciation in response to crises has struck me as being distributionally lopsided, but also as being more about signaling than about substance. So as I sat down to work on the project, I pulled several bills, and I was struck immediately by how many other provisions of the code were repeated from one crisis to the next, oftentimes using exactly the same language as was used in the former crisis legislation. So at that point, I kind of moved from hand-wringing over the expansion of expensing as a legislative signal to really genuine fascination about what the secondary and tertiary effects of this pattern of recurrent legislation might be. And in part because I think that it's possible that nobody in Congress is giving it any thought. So the normative concern driving my investigation is that the hurry up nature of crisis-driven tax legislation necessitates both a patterned and formulaic approach that potentially entrenches equitable failures from prior bills, which has the potential to widen the gap between stakeholders who have assets and income and those who don't. So what this presentation will do is describe my research in progress. I'm going to offer, and the draft is just a piece of this, and I'm going to offer a preliminary account of some of the recurring provisions, but not all of them. I'll highlight some examples of potential distributional consequences of recurrence and offer some initial analysis of the functionality of recurrence as a pattern of legislation in crises. I'll wrap up with some really stray thoughts about how my work might eventually offer insight into ways in which Congress could more selectively use recurrence in future crises. All right, so I'm going to pause here and share my slides with you. So my project begins with three hypotheses, although I'm not claiming any kind of empirical significance for it. And the first is that crisis legislation is formulaic with a number of provisions in it coming from prior tax-motivated or crisis-motivated tax legislation. Second, that subsequent crises will extend or expand the scope of the recurring provisions. And third, that among recurring provisions, privately directed outlays by a tax expenditure generally will outweigh congressionally directed outlays. And what I mean here is that Congress sets aside a pot of money during the crisis to subsidize particular taxpayer behavior, and taxpayers who have money or assets needed to engage in that desired behavior, they get to decide where the money will go. Those are the beneficiaries of that congressional effort. Okay, so to test my hypothesis, I reviewed legislation passed in response to crises during a 20-year period. So I looked at 2000 to 2020. This covers a lot of disaster. There's 9/11 and the subsequent recession, hurricanes Katrina, Rita, and Wilma, the housing market, and the subsequent collapse of the economy in 2008, and of course, the COVID pandemic. So in the broader project, I'm categorizing each provision of the legislation, so each amendment to any section or addition of any section to the Internal Revenue Code, I'm categorizing these along a number of categories, including whether the provision related to individual taxpayers, businesses, or whether it was public finance oriented, whether it's a tax expenditure or a direct outlay. A subset of that is, does the provision apply only to taxpayers who spend money in a particular way or hold particular assets? So this is my to those who have shall more be given scoring. And then some other things like debt loss, is it employee benefit, a change to the rate, reduction, exemption credit, etc. All right. So a couple provisos, which you see there in the paper. I haven't scored any provisions related to the issuance of tax-exempt bond financing. The reason for this is, first off, let me say, these are ubiquitous in crisis legislation. They are everywhere. And they contain significant components of private benefit, but they're also relatively opaque at the statutory level. So it's not like you can look at the face of it and know where the money is going. And furthermore, I've made some effort to try to track it down, but the reporting requirements in the code are obscured by developers' use of shell companies. And so it's really difficult to see where the dollars are actually going. So I've set those aside and reserving them for later. Okay. In addition, I did not include extenders at this point, and that's because their use as a response to a crisis is conflated with the pragmatic requirement for their renewal in some cases. And so it's difficult to determine whether they're an actual crisis response or whether there's something else. So those are some things that I'm reserving for later thought. And then to be clear again, I'm not claiming any empirical significance for the project. And instead, I'm trying to create a positive account of the legislation during the study period. My goal here is to provide some procedural recommendations eventually to shore up and maybe modernize the use of tax law as a response to crises. Okay, so the draft that you have in front of you today is just a first cut at describing some of those recurring provisions and offering some preliminary analysis. What you don't have in front of you today are the numbers. In part, this is because the pandemic has made work really difficult for me. And in part, it's because each time I sit down with the project, I find something new that I didn't see there before. And sometimes it's an entirely new piece of legislation that I have to figure out what to deal with. So like, for instance, this week, I came across legislation related to crisis in Haiti. Do I include that or not? That forces me to think a little bit more carefully about what the parameters of the study actually are. All right, so let's talk about what I've actually done. And I'm going to take each hypothesis in turn, and I'm going to start first with do new crisis tax bills retread prior bills? And this is really unambiguous. The answer here is absolutely yes. So while most bills contain some new material and some contain a bunch of new material, they all contain provisions repeated from prior crises. And looking across 20 years, some clear patterns emerge. And the first is that Congress has a particular response to localized crises. Okay, so when we're talking about harm from a natural disaster befalling individuals, the bill that comes out of Congress often looks like this. It has exemption of disaster payments or payments by charities or insurers to individuals for injury or death. There are some estate tax benefits. Individuals can make a penalty-free withdrawal from tax-preferred retirement savings. The charitable deduction gets expanded somehow. You might see the work opportunity or employee retention credit. And always public finance incentives for housing and restoration of the structures in the affected area. All right, so that's one thing. The second thing is if the crisis is at a federal level, so it's affecting everyone, these bills are much more expansive, and in addition, they're much more expensive. And they always have provisions on both the individual income taxpayer side and also on the business side, in addition to public financing, which, as I said, is ubiquitous. So at the individual level, we see some repeaters from our localized crises. And then on the business side, we're going to add my favorites: increased bonus depreciation, expensing, and expansion of the net operating loss. And then again, the work opportunity and employee retention credits are in here. Okay, so something to notice is that nearly all of the repeating individual and business provisions or tax expenditures, almost all of them allow the private direction of public resources because almost all of them require either spending or asset holding on the part of the taxpayer claiming them. All right, so this brings me to my second hypothesis, which so far appears to be true, although again, I'm not done bean counting. But in particular, depreciation, expensing, and net operating loss are all broadening over time. So with subsequent iterations of the recurring provision, that provision gains breadth. All right, so if we look at a couple of those, and you'll see these in the draft, bonus depreciation, for example, over the 20-year study period goes from 0 to 30 to 50 to 100%. Immediate expensing under 179 goes from $100,000 at the beginning of the period to $1 million by the end. And the net operating loss has been sort of a roller coaster, but has moved from a 2-year to a 5-year carryback and has been more or less deductible, currently 100% deductible in response to COVID. Okay. So as a result of the recurrence in the crisis-motivated legislation, these provisions are steadily expanding, which means that, as I mentioned on the earlier slide, the private allocation of public resources is steadily expanding along with them. And this phenomenon seems to, I am guessing, I mean, I don't have any evidence that Congress isn't looking at it, but there's no evidence that it is. And so this seems to be largely invisible. Okay, this brings me to my third hypothesis, which is that tax expenditures will outweigh direct expenditures among recurring provisions. And here the jury really is still out. I might be utterly wrong about this. So the passage of private expenditure provisions, just if you're just counting them by number, greatly outweighs the number of direct outlays that you see in the crisis-motivated tax legislation. But the stimulus checks, when they happen, which isn't that often, greatly outweigh. And so those are really skewing the pattern that I otherwise would be claiming for this legislation. So by my count, there are 5 bills out there during the study period that have this kind of like big direct payment attached to them. And those are all stemming from federal level crises. So while on the whole, the pattern is to prefer tax expenditures directed at people or businesses who have liquidity or particular assets, when you get one of these big stimulus payments, it flips that paradigm. All right. So what I'd like to do next is think about why this information could be impactful. And if you'll permit me to slip into anecdote, I'm going to use two examples. And the first is withdrawals from tax preferred savings on the individual side. And the second will be 100% bonus depreciation on the business side. Okay, so each of these provisions are provisions that have recurred multiple times across the study period. And at first blush, if you think about the tax preferred withdrawal from retirement savings, it seems like a good thing, right? It provides liquidity to individual income taxpayers who need it as a result of either a natural disaster or a problem in the economy. And this gets money to them. But let's think for a minute about what the immediate and downstream distributional effects are likely to be. And the first and most obvious is this provision only helps people who have retirement accounts. People who don't have those assets have to look elsewhere for assistance. And maybe there's assistance elsewhere in the bill, but oftentimes for people at middle levels or like lower middle levels of income, there's not much there. And reliance on the taxpayer's own retirement account problematically moves taxpayers who use them closer to not being eligible for help in a subsequent crisis. So in areas of the country where crises themselves tend to be recurring, this depletes the very asset to which the relief itself is tethered. Okay, so let's say we have three taxpayers. Here's somebody who has $100 in a 401k and they have $90 of savings outside of the 401k and the disaster happens and costs $90. So if we have a second person who has the 401k with $100 but no additional savings and they have the same disaster cost, they'll be differently situated. And then finally, we may have a taxpayer who has nothing in tax preferred retirement savings. Still, the disaster is expensive. So at the end of the day, what happens? So I'm going to do some silly math and assume a 10% rate of return. Our first person doesn't have to use the tax preferred retirement savings, right? So that investment is going to grow tax-free inside of the account. The person in the middle who's lucky enough to have retirement savings but has no other savings is going to take the withdrawal provided by the crisis legislation. And as a result, that person's going to miss out on this $9 of tax-free growth and become more vulnerable to the next crisis as a part of the bargain. And this third person over here, this person has to borrow to cover the cost, or they're going to have to go basically without. Okay, so this is bad enough on its own, but it's likely to produce racially disparate effects as well, both at the time of the crisis and at the time of retirement. So as Dorothy Brown has noted, for instance, fewer Black Americans have tax preferred retirement savings accounts. And of those who do, they're more likely than their counterparts to take early withdrawals for reasons of hardship. So now if you put that cohort into a natural disaster, because white taxpayers have more wealth outside of the retirement savings, fewer of them are going to withdraw money from the tax preferred account as a result of the disaster. As a direct result, more of them are going to have tax preferred savings to pass along to heirs or to use in retirement. But of the Black taxpayers who are affected, fewer according to Dorothy Brown, are going to have savings. Fewer are going to be eligible for the benefit in the first place. And those who do take advantage of the relief provision then are going to be denied the advantage of the tax preference for retirement savings. They'll have fewer assets in retirement, fewer assets to pass along to heirs. And one obvious direct cause of the comparative shortfall is the government's response to a natural disaster, which might have happened, 2 decades ago, but the cause is obscured by the passage of time. So here's an instance where the recurrent use of a provision could have an effect on the wealth gap over time, but this would be relatively invisible to legislators at the time of passage. Okay. So I'm not suggesting that this cascading effect is intentional. Legislators are likely to be well-meaning here. And this is particularly so if they're using legislation that was crafted by someone else during a prior crisis, because the presumption, of course, would be that the original drafter has considered the secondary and tertiary distributional effects earlier at the time that the provision was created. Upon sober reflection, there's no reason to believe that, and that anything that hitches the distribution of crisis relief to private spending or asset holding is likely to be inequitable. And there's no reason to think that it's non-violative of whatever your favorite definition of efficiency happens to be as well. Okay, so a second example here is, of course, as I mentioned, the bonus depreciation under section 168K. So again, this seems to be designed to put cash back in the hands of taxpayers, and we can see it's a crisis. Congress wants to provide some liquidity, and what legislator would say no to that during a crisis, particularly if the crisis is an economic one. Problematically, though, the provision once again applies only to taxpayers who already have an advantage, and in this case, it's liquidity. So a taxpayer can take advantage of bonus depreciation only if it has sufficient cash on hand, or it can borrow to purchase depreciable property. Okay, so let's say, again, we have three taxpayers. This one has liquidity and needs depreciable property. This one has no liquidity and needs depreciable property. And this is a service-based business that just doesn't use depreciable property. Well, if we really hone in on this one relief provision, this first taxpayer, government aid will be allocated to this person, even though they have a natural advantage among these three taxpayers already. The second one, who has no liquidity but needs depreciable property, well, tough luck. And this third one, again, tough luck. So this requirement that the taxpayer have sufficient liquidity and a need to purchase something that would be actually depreciable drives a wedge into normal market competition in a couple different ways. It magnifies the advantage that the liquid taxpayer has, and it prefers the equipment-heavy business over the service-based one. Both of these distinctions might map onto a disparate distribution of wealth and opportunity. And that's an empirical question for which I have no data. But, think about it this way. Bonus depreciation is going to help out the component parts manufacturer much more than the home healthcare aid. And the former is likely to be wealthier than the latter. Now, I'm sure you can come up with contrary examples. And like I said, there's no data, or at least I don't have the data, so who knows? But if Congress is going to allocate relief in a time of crisis on the basis of a taxpayer's already existing advantages, so if it's going to take the "to those who have more shall be given" approach, it should have some strong normative justification for doing that, as well as empirical support that its allocation is going to accomplish whatever the normative goals for the allocation are. And there's really very little evidence that Congress has given the subject much thought at all, beyond the act of getting cash into the hands of taxpayers who are likely to spend it. Okay. So, all right, so that's the problem. I mean, this is the problem that recurring legislation poses. So if you think of the provisions in the crisis-related tax bills not as being one-off events, but as being part of a larger pattern of legislation, it raises the question of how recurrence happens and whether we can improve it. All right, so the next thing I'd like to do is address some of the ways in which these provisions recur and sometimes ossify to become permanent or quasi-permanent parts of the law. And the first is really easy, and you can see it right on the face of the legislation, and that is subsequent Congress's cut and paste from the language of prior Congress's crisis responses. This probably works great, right? It not only transfers the text from one crisis to the next, but it's also likely to cut and paste bipartisan support for the measure. But other instances of recurrence are more complex. Sometimes Congress packages the relief provisions as zone-based, suites of provisions related to the rehabilitation of particular geographical areas. So you'll see, I mentioned in the paper, the Liberty Zone and the Go Zone fall into this category. These tend to have heavy components of public finance, but all of our usual suspect repeaters show up in there as well. Another way of packaging these provisions in a crisis is to pre-package them. So for Congress to say, hey, look, we're going to group together a bunch of relief provisions, and if the president declares a crisis, then these provisions will, they'll flip on like a light switch. And then some crisis provisions are made permanent in the code. So I name a number of these in the paper. Section 139, about which Ellen April has a paper and a few other people as well, exempts disaster relief payments. So this is one that became a permanent part of the code. And it's switched on again by a federal declaration of disaster. Okay, so these first two avenues of recurrence and the possible ossification of the recurring provisions are reliant on Congress. The third requires both Congress and the president. And in the fourth, you see Congress delegating the responsibility for making the provisions available to the executive. Okay, to reach that point where the president makes a declaration of disaster, the state's governor has to request the federal declaration. After that, FEMA comes in and works with local officials to quantify the problem. And the state's governor then has to determine that the state's resources are insufficient to deal with it, and at that point makes the formal request of the president. So it's worth noting that there are a number of political gates in this process, the president being a very visible one. Okay, so permanence in essence takes a determination that would have been shared by these two branches of the federal government for any particular disaster and allocates it to the one. And many times you might think removing Congress from the process would, promote expediency, but at other times it just may not, right? Everyone remember this? Okay, so that's a problem with permanency. And if we're thinking about what to do about the cut and paste problem, a thought that might occur is, well, maybe we should make some of these things permanent, but permanency raises a new issue. A second consideration with permanency of tax relief is that it adds consequences to the decision to declare federal disaster beyond those that are described by the Stafford Act. So the more consequential the disaster declaration becomes, the more likely it is that the consequences themselves may drive the decision. And it's possible that if enough tax benefits are riding on the declaration, state and federal incentives may skew along political lines with both regard to the request for help and the granting of aid. Okay, a third thing here is that tying tax relief to disasters, to the federal disaster declaration, creates some potential horizontal equity problems. So I want to come back again to three taxpayers. Boy, I love three taxpayers, don't I? Okay, so let's say we have these three folks here. Each one has a flooded house. This first taxpayer lives in a state that is capable of dealing with disasters. The second one lives in a state that is incapable of dealing with disasters. And this third one, who knows where she lives, but let's say a tree fell down on the power line, her electricity fails, it's winter, and the pipes burst. Okay. So all three of these people are similarly situated in terms of the financial shock that has befallen them. But because the declaration of disaster hinges on a federal determination of the insufficiency of state resources, taxpayer one that lives in the capable state probably won't be entitled to whatever permanent tax benefits are switched on by a federal disaster declaration. Okay, so if you tie relief to the disaster declaration, this person is out of luck. Taxpayer two that lives in the incapable state lucks out and is entitled to whatever the federal tax benefits may be. But taxpayer three, who isn't part of a more systemic problem, again, is out of luck because there isn't going to be a federal declaration of disaster as a result of the downed tree. So now we have a variety of results for similar events, and this seems like a sort of a bizarre setup. And this is even more bizarre if you think of these taxpayers as being three businesses that compete with one another in interstate commerce. What's driving the problem? Tax provisions that are tied to the disaster declaration use that declaration as a proxy signal for financial shock. But the problem is it's a poor proxy for at least three reasons, and there may be others. But first, a disaster may not cause a taxpayer to experience a financial shock. Second, financial shock can have been absent widespread disaster. And third, as I described earlier, the involvement of the state's governor and the federal assessment of need create noise in the signal. Okay, so if we are thinking that maybe a way of avoiding the cut and paste problem is by making some permanent disaster-related provisions in the Internal Revenue Code, we have to figure out how to work around this issue as well as the political capture issue. So in summary, recurring provisions in crisis-motivated tax legislation are moved forward through a number of mechanisms, and those that require legislation contemporaneous with a crisis encourage the cut and paste issue for reasons of political expediency. I mean, they preserve congressional involvement, but they sacrifice the opportunity for careful analysis of the proposed legislation because it's contemporaneous with the crisis. Legislation that comes ex ante might provide some more opportunity for reflection, but if we're using the declaration of disaster as an on switch, it creates the problem that you see in front of you. All right, so how do we move forward? Now we've reached the Stephanie's random thoughts part of the project. And I think that the first thing to recognize is that recurring provisions don't come out of nowhere, right? There's a reason why Congress does this. They're a legislative pattern. The existence of the pattern suggests some motivation for it. And the fact that they're ossifying suggests that Congress views them as being functional in some way. Likely it's because they allow Congress to act quickly and predictably when quick and predictable action is needed. And because they've passed the litmus test once before in the political arena, they're less likely to engender political opposition as compared to innovative measures. So any effort at refining or reforming Congress's use of recurrence in crisis-motivated tax legislation needs to preserve this functionality. Otherwise, Congress is just going to ignore it, okay? And I think it's important to realize, too, that recurrence provides some opportunities. And one of those is, this is a great opportunity for data collection and longitudinal analysis. So if we're pretty certain that the objectionable early withdrawal of retirement funds provision is going to be in the legislation every single time, maybe the proposal is let's start collecting more detailed data so that we can track the dollars and make this provision better, right? Or get rid of it. Okay, the second thing I want to point out is if we know Congress is going to recurringly use these provisions, interventions for the recurring provisions are likely to be reintroduced in subsequent crises, right? So we have a chance here to potentially change the DNA of Congress's standard crisis response. So, you can start with the red delicious apple, right? Which is maybe what we have now, and work your way toward the Honeycrisp if you like that one, since the changes to the recurring provisions are likely to be reintroduced in subsequent crises. All right. Second, attempts to intervene in the pattern of recurrence should really be seated in work done outside of the time of the crisis for which Congress is legislating. And here, I don't have the answers for the political process about how to get in there and actually make suggestions, but I think there are some important questions that could inform such a project, and those include identifying common elements of crises or categories of crises, and then asking whether those systemic failures that are common across disasters are amenable to tax intervention. And then we need to ask, well, what does success look like for a tax intervention? And we need to ask that question, not just from the viewpoint of did we put cash in people's hands, but from a multiplicity of viewpoints with an eye toward immediate and downstream distributional consequences. And I think inherent in any effort to reform Congress's tax response to crises is that we just need more data, right? We don't have enough information about what happened in the past 20 years to properly assess its effectiveness, and more information going forward would just be fantastic. All right. A third thought that I have about this is, if we recognize the tendency of recurring provisions to broaden over time, and their sheer recurrence is a potential driver of the wealth gap, there's no reason to think that Congress couldn't pass countervailing measures. So if Congress's preferred legislation pattern inevitably creates winners and losers, or if it'll benefit parties that are not adversely affected by the crisis, it has tools at its disposal to correct that problem, and it could balance that harm through episodic taxation that's tied to the crisis legislation. And these things too, we might find useful as recurring provisions. So here I'm mentioning the windfall profits tax or a payroll tax on high earners as examples, but I'm sure you could think of others. One more thing. Okay, so Congress, if we're figuring out how to address the cut and paste problem, I think it would be useful for Congress to distinguish between recurring provisions that are used as a means of mitigating financial shock to individual taxpayers. It would be useful to distinguish those from interventions that are meant to be systemic, right? That are meant to stop the progression of a crisis. Why do I say that? Well, financial shocks to individual taxpayers, as I mentioned earlier, are not necessarily tethered to a crisis. And there's no reason why they could not, with adequate process, become permanent features of the code available to any taxpayer who's experiencing the requisite financial shock. Tying it to crises, as I mentioned, creates noise in the signal, and we're going to leave some people out who need help. All right. Second, systemic failures of economy or infrastructure are different. They're inherent features of a crisis, and therefore may merit specific intervention. And here's where I think the functionality of recurrence really matters, and where its unexamined use is really, really problematic. Okay, so just to tie a bow on it, I'm gonna pop us out of the slides and say, so there are multiple considerations that should go into building better crisis-motivated tax legislation. Congress's current legislative pattern of reaching for recurrent provisions during the pendency of the crisis doesn't leave room enough currently to make improvements that would better the distribution of opportunities and resources. So I hope with future work that this project could shed some light on the issue by looking at past practice in order to inform future developments. And with that, I just want to say thanks, and I am really, really looking forward to your comments.